All right, welcome back to Yahoo Finance Live on this Monday morning. Well, as 2021 annual meetings have gotten underway, investors have gotten quite a surprise when they look back at the pay packages that so many CEOs received during a time when tens of millions of folks were out of work. Brian Sozzi, Financial Times, looking at this story over the weekend, and they note that there have now been 13 shareholder votes on executive pay packages that have failed. And some executives, or some experts rather, think that that number could rise to as high as 20. Now, there are thousands of public companies and thousands of annual shareholder meetings. So, okay, you've got 20 executive pay packages not getting 50% approval from shareholders. But usually there's about one objection, maybe two, and it suggests, I think, a little bit of the tide turning in terms of how investors and institutional investors, we really mean, view the compensation schemes for many executive classes.
And it has to turn, Miles. It's long overdue. But as you mentioned, a very good story out of the FT over the weekend. And the headline here is investor protests over executive pay have hit an all-time high. Last week, Halliburton was the 13th S&P 500 company to garner less than 50% support for a say-on-pay vote at its annual meeting. All of last year, there were only 12 no votes on say-on-pay. That's according to ISS Corporate Solutions, which tracks a lot of this stuff. So these are, in fact, rising. And ultimately, let's call out two companies. I mean, Starbucks recently, its shareholders voted no on say-on-pay for its CEO, Kevin Johnson, who was potentially could still go reach $50 million plus in bonuses as a 3-year retention bonus. They're viewing it as, but shareholders said no. The thing is, these are non-binding votes, so it's likely a Johnson may still end up getting that bonus along with a GE. GE CEO Larry Culp last year had his contract reworked, where now he stands to make $230 million in terms of bonus. It's just absolutely ridiculous. And I come back to this stat here that the New York Times recently put out. They're noting chief executives of big companies now make, on average, 320 times as much as their typical worker. And they are citing the Economic Policy Institute for that stat. In 1989, that ratio was 61-1. So CEOs have just gotten richer, and it's a tough sell, especially last year, as a lot of companies are canning workers. To see a GE coming out here potentially rewarding its CEO with a $230 million bonus. It's ridiculous.
You know, and this really, Brian, does seem to be sort of the companion trend to what we're seeing for a lot of workers, right? This sort of reevaluation of what am I worth as a worker, right? What am I worth in quality of life? What am I worth in actual salary? And so this seems to sort of go hand in hand with that. Although, to your point, it's not something really that investors have cared a lot about in the past, or at least not enough to voice their disapproval during these meetings. So it is fascinating to see if it will get actually more traction, just as it's fascinating to see how successful workers will be at pushing for better pay and working conditions, et cetera.
It's starting to happen. It's starting to happen because you have the likes of a BlackRock and a Vanguard finally stepping up here and saying, hey, guys, look, if you're GE, you're making $230 million potential bonus. After last year, you fired thousands of workers and your earnings results have been in the tank for the past 2 to 3 years. It doesn't add up. A lot of these packages should be better aligned with revenue, go figure, with revenue and operating profits, things you can't necessarily mess around with on an income statement.
If we ever want a Yahoo U done by someone other than Brian Chung, I know that Sam Rowe could give us a great Yahoo U on how executive comp comes together, because these guys are all benchmarked, and mostly guys, of course, they're all benchmarked to one another. So Sozzi, you say things like revenue, business performance. That's not the point. I am benchmarked to my peer CEO. It doesn't matter what company I run. It doesn't matter if my company's good, their company's bad. It's about how the group is benchmarked. And remember, this all goes also, I think, to ESG. That last letter, G, is governance. And if your governance is going to allow, some ridiculous multiple of average worker pay, if your CEO comp has some ridiculous multiple of your average worker pay, then maybe that's how a BlackRock gets involved here, Fidelity, State Street, some of these big investment houses to say, hey, this needs to be brought into line if we're going to be investing with you as part of this strategy, which of course we're putting all these resources into, so on and so forth.